All right. Welcome to CRE Pro Course. I'm Zach Rasinger. As always, we're here to deliver value, and we believe everything else will follow from that. Today, we've got a very, very special three definitions, three ratios that are going to help you from day one, minute one in commercial real estate. Let's just jump right into them. But just so you know, everybody in commercial real estate will be using these three topics, these three definitions, and these three ratios in order to evaluate deals. So it's really important that you know from day one, minute one. It's great to review them on a periodic basis, but let's just jump right in. Our very first value delivering ratio or definition is net operating income. So your net operating income of a commercial real estate property is calculated by evaluating the property's first year gross operating income and then subtracting out the operating expenses for the first year. It accounts for vacancy and operating expenses, and of course you want a positive NOI. It doesn't account for mortgages. It doesn't account for payments to private lenders or capital reserves. So it's really pulling the financing out of the equation. It's saying how much are you actually making at the end of the year? What kind of investment is it? Is it a positive or negative? And of course, you want a positive NOI. There are going to be two NOI numbers. One of those is going to be the actual, like today, what's happening today in the current situation that the building is in. And then the other will be the pro forma. So if you're making an investment and you believe that there's a value add component to this, your net operating income projected in your pro forma will be a little bit different. Hopefully it's more positive than what it is today. And the NOI can be used to find the cap rate or the purchase price. So speaking of the cap rate or the capitalization rate, that's our next definition here, or our next equation that you're going to use all the time. It's something that's used and frequently referred to inside of commercial real estate deals. It allows you to sort of compare apples to apples. Let's say in a certain market, you're able to take two properties that are similar, and they could be in different asset classes, they could be in different locations, but it allows you to have a comparable price between two assets, and that has to do with calculating the value of the income producing property. So cap rate is used to estimate the net present value of future profits or cash flow. The equation for it, very simply, is the net operating income divided by the purchase price. And it's going to determine whether the building is over or underperforming. It's also going to help you determine the fair market value. So it's extremely important to know how to calculate the cap rate and what the cap rates are for the various buildings in your area or in your market. The third one, and the most important, the one that I love the best, is the cash on cash return. This is super important if you're making an investment in a building, or if you're working with clients who are doing the same. You want to make sure that they understand how much they're going to earn year one. So in commercial real estate, investors who are relying on financing to purchase their properties, they often adhere to the cash on cash formula to compare the first year performance of competing properties. The cash on cash takes the fact that the investor is in question doesn't require 100% cash to buy the property, but it also accounts for the fact that the investor will not keep all of the NOI because they must use some of it to make mortgage payments. So obviously all investments are coming in exactly in cash, and so this is going to allow you to accommodate for that. To uncover the cash on cash, the real estate investors must determine the amount required to invest to purchase a property or their initial investment. What it is the NOI divided by the cash invested, and then you're multiplying that by 100%. And I'm going to show you exactly how to do that. We've got a final slide here, which is an example of how to calculate cash on cash return. You should absolutely understand how to do this and be able to do this in your sleep. Again, this, if I don't have a tattoo, but if I got a tattoo, it would be one of these three ratios, and I can pretty much guarantee you that it would be cash on cash return, because I love to show my investors cash, and I love to invest in deals that are cash flowing and those that have a great cash on cash return. So if you had a $100,000 purchase in this case, and you put 20% down, you also have $5,000 that you needed to bring in closing costs. In total, you have $25,000 down. So the net operating income of this property in particular, let's just say it's $3,000. So we have, that's the income from the property. So the rents minus the expenses, what it costs you to run the building. And so we're easily able to calculate what the cash on cash return is. It's $3,000 divided by the $25,000, or a 12% cash on cash return. Just to note that the average in today's market is around an 8%. If you have any questions on any of these three or any of the 350 different definitions that we give with examples inside of the Commercial Real Estate CRE Pro course, link below. If you have any questions about that or anything else, please reach out. Happy to help. Again, I'm Zach Rasinger. I'm the co-creator of the CRE Pro course, and I'm here to deliver value to you.